Price increases are at their highest level since 2008, and this affects you and every single person you know. But is this a case of an overheated economy and rapid inflation, or is this a natural part of the recovery, the economic recovery that we are seeing right now? So let's break this down so we can better understand the new data that has just come out on inflation and price increases, some possible scenarios here, a piece of inflation that I feel like doesn't get talked about enough, and then some strategies to combat inflation in your investments and your cash position. How can we hedge against inflation? And let's just go ahead and dive right in. Starting off with the new data that just came out from the BLS. Let's pop over to the screen here real quick. Okay, this is an economic news release that just came out on June 10th about the CPI. Now, the CPI, the Consumer Price Index, represents a basket of goods and services that the average American purchases, and then they measure the current prices of that basket of goods to prices in the past to see which way prices and the economy is headed. Are things getting more expensive? Are they getting cheaper? And we'll cover exactly how that methodology works in just a second here. But the Consumer Price Index for all urban customers increased 0.6% in May alone, in 1 month on a seasonally adjusted basis, after rising 0.8% in April. So things are getting more expensive, especially depending on the industry. Over the last 12 months, all items on the index increased 5% before seasonal adjustment, and that was the largest 12-month increase since the 5.4% increase all the way back in 2008. So things are absolutely getting more expensive, and the data is here to show that. But is this inflation? Is this actually inflation? The index used for cars and trucks saw one of the greatest increases in the recent past, with a 7.3% increase in May. And this increase alone accounted for 1/3 of the total CPI increase, because it's just such a large factor here. Now, if we scroll down, we can see the individual industries here. We can see food has increased slightly in the last couple of months. And where is vehicles? New vehicles, kind of flat, increasing a little bit here, but used cars and vehicles in April, an increase of 10%, and then in May, an increase of 7.3%. And we're seeing all sorts of just crazy stories of people who bought a vehicle, had it for 2 years, and now they're selling it for the same price they bought it for, which is an anomaly in itself. That's not something, the classic, you drive it off the lot, it decreases so much in value. That's not happening right now. So if you have a used vehicle, now's the time to sell that used vehicle, because it is expensive to buy a used vehicle right now. So that is disproportionately skewing the results here. 1/3 of the increase has to do with used cars and trucks. But everything is generally up. All items, 0.8%, 0.6%. Food, again, 0.4% the last couple of months. Utilities, seeing a small increase, but these are just all increases. Shelter, 0.4% 1 month, 0.3% 1 month. That's a lot for housing expenses, which housing expenses aren't directly factored into the CPI, but they consider it shelter expenses as kind of an ancillary way to do this. Now, scrolling down here a little bit further, this is just what it's based on, how they collect the data. So they established this from 6,000 housing units and approximately 22,000 retail establishments in order to get their data. And there is a little bit of a wiggle room here for inaccuracies, but they're 95% confident that these numbers are within a small margin of error. So it's fairly confident in these numbers. And of course, you can feel it too. We can feel that prices are increasing here. Now, the logical question is this cause for concern? And we just really don't know at this stage. And it varies depending on who you ask. If the issue is that we just simply have too much money circulating in the economy and the supply of goods and services can't keep up long term, it's not just a short-term issue, then we may have a problem where the solution would be less spending and raising interest rates, and possibly decreasing the money supply by the Fed selling corporate bonds back. That may be the solution if that's the case. But if the issue is if it's a temporary supply shortage as consumer demand and consumer confidence goes up, then we're probably okay. It's probably a temporary situation that we're in where prices are fluxing and then they'll settle off a little bit. And it seems like the odds are on the second scenario, that this is more temporary. Of course, we don't know for sure, but it seems like this because the areas with the largest impacts price-wise are those with the greatest shortage in basic supplies to create those things, like automobiles and the microchip shortage and housing, with things like lumber and copper expenses just going through the roof, no pun intended. It seems like those areas are being the most impacted. So it feels like it's leading towards the more temporary side, but that doesn't mean there aren't real effects. Now, there is another piece of the puzzle that doesn't exactly get talked about much, and that is the potential labor shortage. Now, data shows that there are around 3.5 million fewer people in the workforce right now relative to February 2020, all while businesses are trying to hire everywhere. If you drive down the street, everyone is trying to hire, but there's fewer people in the workforce. Now, many people have pointed to enhanced unemployment as the reason for this possible shortage, even prompting some states to stop these enhanced benefits early. But however, it seems like this is likely the case, at least likely that it's causing some part of this issue. We just can't know for certain until the data comes out. So I don't want to say, hey, this is the reason this is happening until we actually have the data to look at, because I'm not just here to make claims. But we have a few stats to keep an eye on just to see what happens in September when those unemployment benefits end. That way we'll know, okay, was this directly tied to unemployment or not? And from here, we can take a look at the BLS's labor statistics that just came out. If we scroll down, you want to keep an eye on the labor force participation rate and the unemployment population ratio. So for the labor force participation rate, the participation rate is currently 1.7 percentage points lower than in February 2020. And then the employment to population ratio is at 58%, which is down 3.1 percentage points from February 2020. So you want to keep an eye on these two data points just to know, is this actually the cause of the labor shortage or not, once we have that data come the end of September and then potentially October. So it'll be a while before we actually know the truth behind what is going on there, even though it seems like that is likely the cause. But despite the cause, we know a lack of labor can absolutely increase prices. I mean, let's just do an example. Let's say you own a drywall business. You install drywall for new construction, and your phones are absolutely blowing up for new jobs as constructions are just going up everywhere, but you can't find anyone to hire. So your logical choice is to just increase prices, and by you increasing prices, this causes a chain reaction that can eventually affect new home prices. So we all know that there will be inflation, but how bad will it be? Now, the Fed has said in previous remarks that the long-term goal for inflation is 2%. However, we may see higher rates before it levels off so that it can average at around 2%. Goldman Sachs predicts that inflation will peak at 3.6% year on year in June of this year before averaging down to 2.7% in 2022 and then averaging even lower in the years after that. Now, Treasury Secretary Janet Yellen has said inflation could be as high as 3% this year. So she's feeling a little bit more on the safe side. Yellen believes that the effects we're seeing are a temporary result of coming out of the pandemic, reopening, vaccines, and people spending their savings and doing things like going on trips, buying used cars, buying things like that. And also, the Fed has said they are in no rush to combat inflation just yet, which also just kind of always concerns me when the Fed and the Treasury are like, there's nothing to worry about yet. Like, I want you to be worried about this. I want you to be concerned, and I want this to keep you up at night. That way I know that you are doing the most, on this. Whenever I hear it's okay, it's concerning to me. But that's what they're saying as of right now. So now let's talk about how you can fight against inflation in your investment portfolio or in your cash position. And there's a problem here, because neither stocks nor bonds tend to perform well historically when inflation is high. They perform pretty poorly when inflation is high. But there are a few things that you can do. If you're trying to be extremely defensive, you could buy Treasury inflation protected securities. Now, this is an investment that fluctuates with the CPI and that's bought directly from the Treasury. Let me show you the website here real quick. So this is a website, you buy them directly from the Treasury in $100 increments. Now, with this, like I said, this is a very, very defensive strategy, and you're not going to get a great return. You're looking at around a 2% return. This is a very defensive strategy. Probably not the strategy for most people. This is probably for, very, very rich establishments and people who are, worried about that 2%. But next we have commodities. Now, commodities have historically performed extremely well during periods of inflation. The average annual return is 14% during inflationary periods for commodities. Now, there's a couple ways you could do this. You could just buy corn commodity, you could buy grain, you could buy things individually, or you could buy some ETFs like this. So I'll leave this site down below with various commodity ETFs. You'll want to, do a little bit of research as to which one to look into further, but an ETF at least will make you a little bit more diversified. And we know that commodities perform, it's the best asset class during inflationary periods. And then other assets that perform well during these periods include residential real estate, which we're seeing huge appreciations in price, art, wine. However, even those don't perform quite as well as commodities do on average during these times. And then we have things like gold or Bitcoin that could be used as a hedge where, those can provide solid returns, but I'm not sure that they are the best inflation hedge, as they can be very volatile, especially with cryptos. I'm a big fan of cryptos. I am very bullish on the outlook for just the crypto industry as a whole. But if I think my only goal is to hedge against 3% inflation on my cash position, if that's all I'm trying to do, I'm personally not going to hedge by placing money in something with up to 10% daily swings. I'm not going to risk a 10% daily swing to potentially save 3%. That just doesn't make logical sense to me. So for an inflation hedge, seems a little bit too volatile to me, but there are options with commodities, real estate, things like that you could look into. So I hope that this was helpful. I did a ton of research on this, so just make sure you hit that like button, subscribe if you haven't already. And I would just like to thank you for watching, and I hope you have a profitable day.